We are going to question number 2. Alpha Limited and Beta Limited are identical except for capital structure. Now we can compare it. Alpha has a 50% debt and 50% equity. So let me write it down even. Alpha and Beta. Alpha is having 50% debt, 50% equity, whereas Beta is having 20% debt and 80% equity. This is less risky. This is more risky. I am writing it because every time something which is on left hand side does not mean it is less risky. Here alpha is more risky because the debt proportion is more. All percentages are in market value terms. The borrowing rate for both the companies is 8% in no tax world, and capital markets are assumed to be perfect. See, what we are learning are capital structure theories. In theories, the author takes some assumptions also. And which type of assumptions are taken? Number 1 assumption, there are no taxes. Number 2 assumptions, capital market are perfect. That is, all investors are very much rational. All investors are intelligent. If you own 2% of stock of Alpha, what is your return if the company has net operating income, this is EBIT, of 3,60,000, and the overall capitalization rate KO is 18%. Whenever KO is given, believe me, it will be net operating income approach. What is the implied required rate of return of equity? This is, they are asking KE. Alright, and second we will be learning. Correct. Let me first draw that marginal costing statement. EBIT is 3,60,000. It is for alpha or beta? Alpha, and beta also, because they are same in all respect except capital structure. Alright. Minus interest. It is 8%, but we don't know the amount. How to find out amount? Will be doing it. This will be earnings available to equity share. Can I find out value of firm? Yes. EBIT divided by KO, and KO is given, is 18%. So EBIT divided by KO will be value of firm. 3,60,000 divided by 18%. It is 20 lakhs. And you know, in net operating income approach, value of firm remains same. Also, it will be 3,60,000 divided by 18%. Yes. Can we find out value of equity and value of debt? The answer is yes. Why? The percentages which are given is of market value. This percentage, 50-50 percentage. So your value of equity would be 10 lakhs and value of debt would be 10 lakhs. Your value of debt would be 4 lakhs. Value of equity would be 16 lakhs. That is, in this it will be in the ratio of 2:8. In this it will be equal ratio. So I am having value of equity, value of debt, and value of firm. Now I can find out interest. What is value of debt? 10 lakhs. What is interest rate? Is 8%. So 10 lakh into 8% is 80,000. What is value of debt? 4 lakh. What is the interest rate? Is 8%. So 4 lakh into 8% is 32,000. This is 3,60,000 minus 80,000 will be 2,80,000. This will be 3,28,000. This is earnings available to equity shareholders. Now, can I find out KE? Yes. What is KE? Earnings available to equity shareholders divided by value of equity. I have derived this formula from the formula of value of equity. So this divided by this. 2,80,000 divided by 10 lakhs multiplied by 100 is 28%. 3,28,000 I'm sorry, I have made some mistake. Your equity is 80%. So this is 16 lakhs. And value of debt is 4 lakh. Is this correct? 4 lakh into 8%. Yes, this is correct. 32,000. So 3,28,000 is correct. Value of equity is 16 lakh. So 3,28,000 divided by 16 lakhs multiplied by 100 is 20 point. Try to concentrate. This will explain net operating income approach, and it will explain even point 2 even. This is less risky. Otherwise, both firms are same, but this is less risky. I am explaining net operating income approach by this red pen. As you increase a debt proportion in your capital structure, say this, your value of firm will remain same. Because there is increase in risk, why KO should decrease if there is increase in debt proportion? Because KD is less than KE. So KO should decrease. But why it will not decrease? Because on other hand, the expectation of equity shareholders will increase because the risk of the company has increased. So equity shareholders will demand more. Instead of 20.5% in a similar company, they are demanding 28% because the risk of the company has increased. So KE will be more, and so KO will remain same. And so it proves net operating income approach. What does it say? As you increase the debt proportion, KO should reduce because KE is more than KD. Also, KO should increase because the expectation of equity shareholders will rise. And if this will be there, this will offset each other. And so KO will remain same, even value of the firm will remain same. Net operating income approach, excellent example of net operating income